Hi, this is the weekly recap for the current trade, September, October, and we start with September. September is doing okay, but the call credit spread is now starting to give us some trouble. Although I would very much like to keep some negative delta preparation for a much needed consolidation, maybe it's also time for a very mild risk reversal. This I would probably go for a call debit spread here to reduce the risk. At the same time, we would reduce the profit potential by quite a bit. So that would have to be accompanied by maybe a broken butterfly or just simple PCS here that would reduce it by just $3-4, I would say. Oh, $6. So it's quite a lot. Um, the additional capital usage would be still okay. We're not using that much. We're about 70% of planned capital, so that's not too much of a trouble. So if you are a little bit concerned about the market pushing higher, that's something that can be done to really limit the upside risk potential here. If you are concerned about capital usage, this can also be balanced by a PDS here, but that would cost even more. No, I mean about $800 here. I mean the risk is about okay. We see where we're losing, where we make money. Basically, it's de-risking, so it would definitely reduce the risk here, but we lose potential about everywhere else. So I'm not sure I am going to go for this. We can afford to do this. Of course, we can also try and place them closer to ATM structure with by way of a broken butterfly maybe placed around here. So we would definitely reduce the risk here, reduce potential profit around here, but we'd probably be better covered all the way down to 31.50 over the next few weeks. Another 2.5, 2.3 exactly. So this one would, of course, it would cost more money, 8.2 here. So maybe for those who are a little bit more bullish, can go for something like this. Over this range from to about 31.75 to 34.50, we would be doing okay. Here we would not lose much. 375 is okay. I mean the upper expiration line would still be about 4% or $1,000. So that's something that could be considered. We have to, of course, take note that it would cost more money here. So it's not just a more bullish outlook, it's also looking at capital being used in this trade. I don't think I will go for this one, and to be honest, there's not much risk just yet. At 39 DTE, I would really like to get to like closer to my 4 to 5% profit. Let's look at planned exit would be around here. So of course we take a chance on the upside. Downside would be great. It does definitely add some risk on the upside if we don't do anything. So by planned exit, if the market does not retrace strongly, we could be in trouble closer to 3400. I shall not leave this trade unchanged. Doesn't mean I have to adjust it today or over the next few days. Unrealized loss here is still quite acceptable. So we can maybe just go for a PCS here just to flatten delta a little, and it costs about $2,000. So maybe it's just a small touch here or there. I don't think it's necessary to go for a reverse Harvey, but that's something also that can be looked into. So if we do a reverse Harvey here, there's only $4 here, so then we would probably go for a risk reversal of that kind. That's probably my favorite adjustment. It doesn't cost much in terms of capital. It's a mild reversal because we just add a call butterfly here with a PCS. So it's a matter of placing the PCS either here or slightly below. If you want to be a little bit more bullish, you can even just do the full Harvey on the wall. So that would be pretty okay. So this is of all, this has been my little brainstorming for now, and this is probably my favorite, considering that $4,000 is okay on capital usage. So this is probably my favorite adjustment, risk reversal adjustment for the time being. Now let's have a look at October. October, there's no need to do much here. It's a matter of watching. October's got a good volatility structure. If you look at the VIX, at VIX Central, you see that there's still that bump near election times. So volatility, it's still a good time to actually sell some volatility in October. So I am not concerned so much about adding some Vega on this trade. 51 Vega is nothing. So let's have a look. If we go closer to the money, that's typically something we could afford. That will cost nothing, just less than $1. We would add theta on a large range. The upper expression line is still fine. So this is typically something we could do. The price is still okay, and we do have about the same downside cover for a while. And if we assume the market could settle abruptly to 3200 or even 3125 without a strong vol spike, this trade should still be doing okay. So maybe we can be slightly more conservative and pay also a little less here by placing it one notch lower. It comes at about 60 cents. The adjustments on October or additional capital in October would be on along this line. Okay, that's it for now. Thank you for watching, and for those who follow me on Slack, I will be there later today. Bye for now.